The following content is meant purely for educational and informational purposes and should not be relied upon as financial, investment, legal, tax, or any other professional advice. This is the Fundamentals Podcast, where we demystify crypto and help you navigate this ever-evolving internet-native economy. In this episode, we're joined by Jay Jog, the co-founder of Sei, a general-purpose, open-source Layer 1 blockchain offering infrastructure optimized for the exchange of digital assets. Over the next 40 minutes, we discuss what Sei is and what the main optimizations are that they have focused on. We cover the current state of the blockchain market sector and Sei's position within it. We discuss striking a balance between efficiency and decentralization. We walk through Sei's current developer and user bases, break down the importance of EVM compatibility, and as a timely topic, cover why Sei would be a suitable option for the specialized backend that MakerDAO's new chain needs. We also break down Sei's economic model, what the best metrics are to measure the success of an L1, and much more. Tune in for a great discussion about the fundamentals of Sei and the broader blockchain market sector. Hi, Jay. Welcome to the Fundamentals Podcast. It is great to have you on.
Awesome. Thanks for having me on, Oscar.
Yeah, my pleasure. It's going to be great to dive into the details behind Sei and also just the current state of the blockchain market sector. Now, before we dive into the details on those, it would be great if you can start by walking us through Sei's core value proposition, maybe both from a developer's point of view and then a user's point of view as well.
So internally at Sei, we have one core thesis, which is that the exchange of digital assets is the most fundamental use case for crypto. Like every single application that has found product market fit in crypto right now is either directly or indirectly a trading application. So for example, if you look at Uniswap or OpenSea, these are very straightforward exchanges. You go there and you trade assets, very clearly trading applications. But it becomes a little bit more interesting when you look at things like, let's say, STEPN. STEPN, Axie, these are games, but there's an in-game marketplace component. In STEPN's case, that drives a large portion of the transaction activity associated with the game. So even though it's a game, it's still a trading application. Now, even if you look at something like MetaMask or Aave, they're interestingly trading applications as well. In the case of Aave, the core source for its demand is people who want to borrow money to then go and trade it, speculate on whatever the most recent meme coin is, for example. In the case of MetaMask, people install it to then go on chain so that they can then do primarily trading activity by like going to Uniswap or OpenSea or something on chain as well. So everything in crypto right now is tied to trading. Then it's becoming clear that there's more and more appetite to start trading on chain. First of all, there's much more, adoption and education happening around crypto year over year. So if you look at right now in 2023 versus like 4 years ago in 2019, it's just an order of magnitude difference in terms of the types of applications that are there on chain. And just in terms of the amount of user activity happening, even in the middle of a bear market, right? So there's just a ton of activity that is happening and will continue to happen. Like there's just more and more crypto adoption happening. And there's also more pressure from regulators on centralized exchanges. Like we saw this increase after FTX happened, but just in general, centralized entities are being targeted more and more by regulators. So there's going to be a push from having some portion of this activity happening off-chain to happening on-chain instead. So there's clearly more and more appetite. The question is then, what is preventing more adoption from happening on chain? Why is most of the adoption still centralized, or still based on centralized entities? Like, why would people primarily go to like Binance or Coinbase instead of going to something on chain and trading instead? And the simple answer to that is that right now, the user experience is lacking. Like going and doing something on chain is just fundamentally more difficult than doing that same thing off chain. Because there's multiple issues that we saw. One of the first issues is that it's just really clunky. The process of onboarding to do something on chain is just much more time consuming. And if you're not like super invested in the process, there's a very high amount of friction that you have to go through. Secondly, latencies are really bad. If you do anything off chain, like in any kind of Web2 approach, it's super simple, right? Like you go to a website, you click a button, things happen. In the case of crypto, you have to like sign a transaction and then you have to wait a good amount of time for transactions to be finalized. Like that leads to a lot of friction. And beyond that, gas fees are also just really high right now. And this definitely depends on which network you're on, but fundamentally you can't have that many transactions being submitted at the same time because otherwise it'll lead to congestion and this will then lead to higher gas fees. So we saw a bunch of issues with this, and that's why we decided to start building Sei. So I believe the question you asked is, what is the core value proposition that we offer to teams? Yeah. So the core value proposition is that building on Say will enable you to offer a better user experience to anyone that is using your application than building that same app in any other ecosystem. Because we're focused on the most important critical thing, which we don't think is just a pure technical problem. We think it's more focusing on the user experience. And based off that user experience, we figure out, okay, what are the components that need to be improved? And that's how we figure out, okay, these are the optimizations we want to be making.
Got it. And then, yes, you're spot on. Everything in crypto is pretty much tied to trading. And I guess one of the core reasons that you exist is that the existing blockchains or solutions out there haven't been optimized for that use case, even though it is the bulk of all activity happening in crypto. Now, the optimizations you pretty much described there, if we dive into them in a bit more detail, compared to other blockchains, what are the main optimizations that you focused on to enable this catered solution for the trading use case?
Yeah, it's a fun one. So when we got started, this was back in 2021. I'm not sure how much the audience knows about my story, but super high level, we were trying to build an exchange ourselves. Then we realized that the infrastructure was lacking, and then we started building a layer one to help support trading applications. And I mean, that was kind of the origin story. And one thing that we noticed at that time, we looked at all of the players that were there. So specifically, we were really considering Solana and Ethereum. And then we also have started to see newer chains like Aptos and Sui. And there's a few buckets of things that need to be improved. The first and most important is time to finality. Like right now, it takes several seconds for transactions to be finalized in most major networks. In Ethereum's case, it will take dozens of seconds. In the case of Solana, Sui, these are supposed to be really fast networks, but it still takes on the order of like 3 to 4 seconds for transactions to be finalized. And even in Aptos' case, it's still around a second. So what we realized is that in Web2, like if you go to Amazon and you try to do something, it's instant. And they try to make it as instant as possible to prevent user drop off. Like that's one thing that they've just completely optimized in every single e-commerce flow that exists in Web2. Because the longer it takes, like if it takes 0.1 seconds, then people start noticing some type of delay. If it takes a second, then people just mentally completely check out. If it takes a few seconds, people literally just leave the web page and they go and do something else. In the case of crypto, it's just accepted that, oh yeah, if it takes 5 seconds, that's totally fine. We don't think that's a world that's going to be that we want to see 5 years from now. We think that 5 years from now, whatever type of infrastructure is being used, it's going to enable user experiences that are identical to that of Web2. So from our side, we really focused on decreasing the time to finality. And currently, Say is the fastest chain in existence. It offers 390 millisecond time to finality. The number itself, I guess, for listeners that aren't super tuned in with like these time to finality numbers, the number itself doesn't necessarily matter as much as the fact that it's an order of magnitude faster than every other chain. And Say is currently in mainnet right now. So these are numbers that are seeing production traffic on mainnet. The way that we achieved this was by changing the consensus mechanism. We introduced something called Twin Turbo Consensus. And we basically started off with a BFT consensus mechanism. And then we just profiled every single part of execution. We saw which parts were slow, which parts are fast. And we realized that there were a couple of things that were really inefficient, specifically block processing and block propagation. And we thought to ourselves, how do we make this faster? So we came up with a bunch of ideas, and that led to Twin Turbo Consensus, which helps us get down to this low time to finality. One other thing that I will say is really interesting about our consensus mechanism is its single slot finality. So what does this mean? Single slot finality means that for a block to be added to the network, there needs to be consensus amongst all the validators, and then it can be added. And then there can't really be any reorg that happens. Now, this is completely different than networks like Bitcoin or Ethereum or Solana. All of these networks are multi-slot finality networks. So a block can be added to the chain, but then afterwards a reorg can happen, and then that block might be dropped. Now, let's say you're a trader and let's say you want to buy a position on chain, you want to buy 1 ETH, and then afterwards you want to hedge it on Binance or you want to short it on Binance. Well, what are the different ways you can do this? In a single slot finality world, really easy. As soon as the transaction is finalized, you just hedge it on Binance. In Say's case, that happens in 390 milliseconds, so you're good to go. You don't really have to take on that much risk. If you're doing this on Ethereum, then you open a position on Ethereum, and then you can either immediately short it on Binance as soon as the transaction is part of a block that's added to the chain before it's finalized. In that case, you might run into a situation where there's a reorg that happens and your block actually gets dropped. And now you're just left holding the short position on Binance and you no longer have the long. So in that case, you're just taking on additional risk, which is terrible. And then you kind of resolve this by introducing wider spreads, and that's bad. The second thing that you could do is you could just wait until the transaction is actually finalized. Let's say that takes like a minute on Ethereum. then you wait until the transaction is finalized, and then afterwards you actually hedge your position on Binance. Now, during this minute, you're getting exposed to all the volatility that can happen. So if there's like 20 bips of price movement, then you're eating that 20 bips of volatility, and that is just going to be a loss that you're taking on. So the way that you account for that potential risk is by offering wider spreads again. So all that is to say, single slot finality really improves the user experience. Multi-slot finality is bad. And we do not think the future is going to be one with multi-slot finality. Interestingly, Ethereum Foundation agrees with us because that is part of their roadmap, like how to introduce single slot finality, because like it really does just improve the user experience a ton. The second thing is around gas fees. So you really can't have a network where there's too much congestion that happens, because then you can't have a lot of people that are using it. This is something that Ethereum struggles with a lot because gas fees just end up spiking and it just makes it really difficult to be doing anything on chain. So one of the things that we introduced is parallelization. And this helped us get up to 20,000 orders per second. Again, the number is less important than the fact that it's a magnitude higher than most other networks. Most other networks see between 1 to 3,000 orders that they can support every second. So it ends up, once again, being supporting an order of magnitude more activity. And the last thing is around user experience improvement, specifically around front-running prevention. So the way that things work on chain with most networks is they're completely general purpose, and they don't really do anything to prevent MEV, which is maximal extractable value, which is essentially the value that a validator can get by ordering transactions in a specific way. In Say's case, what we do is Say uses frequent batch auctions to help prevent front running within the scope of the block. So I can go into that more as well if helpful, but I mean, high level idea there is that Say prevents front running, which stops bad actors from exploiting users. Yeah, so those are a lot of the improvements that we made.
I love that the optimizations are focused on increasing user experience. That is what this space truly needs in so many ways. And the speed that you've been able to achieve is truly impressive. Now, if we think about the kind of exchange trilemma, where it's tough to crack all three of scalability, decentralization, and capital efficiency, I would like to speak a bit about the decentralization aspect and how you strike a balance between the very high level of like efficiency that you've achieved and maintaining decentralization as well.
So I think for any distributed system, for especially any kind of blockchain, decentralization is critical. And it's definitely a spectrum. So from our point, one of the kind of higher level ways that we approach solving problems is we want to focus on the user experience first, and then figure out everything else based off of offering the best user experience. Now, other networks take a fundamentally different approach. I think Ethereum would be the most clear example of that, where it's much more focused on, okay, we want to support as many nodes as we can. We want to have as many validators as possible, even if it comes at the expense of offering good user experiences. So we think that it is fundamentally a naive way to think that you can offer really good performance while still having a massive validator set. These two things go kind of opposite to each other, especially if you want these validator sets to have really low node requirements, which is one of the specific things that Ethereum is really focused on. So we think that the way that the industry is going to be moving forward, and there's very clear writing on the wall with this already, is that supporting a large number of validators is going to be less important for decentralization than having the ability for end users to verify that whatever transactions took place were like being able to verify that the head of the chain is correct and that there was nothing incorrect about the transactions that took place. So in Say's case, the way that we're going to be approaching this in the longer term is by having zero knowledge light clients. So light clients that any user can run. So this could be run on your laptop or your phone, just doesn't really have any kind of high hardware requirement. And this can be like an infinite number of light nodes that could technically be supported. And these light nodes would just be verifying a zero knowledge proof of the state transition that took place. And this would allow it to have very strong guarantees that whatever transactions happen legitimately. So in terms of your core question around decentralization, we think that verification is going to become more important for the industry in the longer term. We don't think that number of validators is really a good metric for anything. And yeah, I mean, as a result of that, the primary focus from Say's side is, first of all, on offering the best user experience. And secondly, it'll be supporting good ways for verifying the chain.
Got it. Yeah. Now, if we zoom out a little bit to look at the broader blockchain landscape, we have general purpose blockchains that have pretty much established their place as settlement layers where L2s, L3s being built on top of them. And then we have more application specific blockchains that are becoming more and more common. And you're kind of in the space representing more of a vertical specific blockchain, if I can use that term. Now, if we think forward many years into the future where we live in a crypto native world, How do you see Say being positioned kind of relative to everything else going on in this space? So what will your role be in this crypto native future?
Yeah, so I guess maybe taking a step back, the way that we approach, like the way that we even think about building products in general, comes from kind of our background from Silicon Valley. Like me and my co-founder, we both grew up in the San Francisco Bay Area. Our entire initial team was based in San Francisco. And we approach building products with a very Silicon Valley mindset, which is build something that is solving a core user problem. Like if you listen to any Y Combinator podcast or any Y Combinator interview, that is the key message that they keep drilling into everyone. I think most, or at least a lot of the crypto industry, it feels like it is building technology for the sake of building cool technology versus building technology for the sake of solving a problem that a user has. And this results in fundamentally different types of products and approaches that you end up seeing. We think that the most important thing is to really solve this user experience problem because that is what's really preventing adoption from happening on chain. And from the user experience problem, there's a bunch of different technical innovations that we realize are important. Things like parallelization, consensus improvements. A lot of the other chains out there, they basically focus on one of these. That's their entire product. And it doesn't really fit into any kind of broader thing that they're trying to solve for. In our case, we realized that, oh, these are all fundamental Legos that contribute to building this overall system. So that is going to be our primary focus. I think that if we succeed, like trading is one of those things that ends up being a magnet for liquidity. It ends up being a magnet for users. It ends up being a magnet for developers because if there's any liquidity and use like organic retail activity happening in an ecosystem, it's incredibly strategic for a new type of application to launch in that ecosystem. That's why Ethereum L1 is succeeding, even though from a pure technical standpoint, it's not really that good compared to alternatives at this point. But it does have a huge amount of traction because it has already become a magnet. We think that if we're able to build this type of user experience that rivals Web 2, then Say would become something that is a magnet for all trading activity to be happening. And in general, trading activity and blockchains, they tend to be winner take most markets, where you can have a bunch of different blockchains, but the top like 2 to 3, the top 5, they end up having a ton of the activity that you actually see happening. So yeah, that's how we see things moving going forward. We've also started seeing more and more trends amongst like modular chains, integrated chains. Our take on this is that the chains that end up having the best performance in the future, they're all going to be monolithic chains. We do not think that modular chains will be the ones that enable the best performance. With that being said, we think that it is possible for modular chains to offer different types of benefits. These benefits would be around experimentation and also around potentially having strong narratives that result in users coming on because of alignment with whatever the narratives of that chain is. So 5 years from now, I mean, I do think monolithic chains like Say will be offering the best performance. But in terms of who actually ends up getting adoption, I think it is whoever is able to get strong narratives and strong killer applications on launch in that ecosystem.
Yeah, that makes a lot of sense. Now, it's funny that you brought up the fact that there are a lot of projects not necessarily solving any clear problem out there. And that coming from your background in the startup world, if you look at the basic pitch deck template, the problem should be slide number 2 after your logo. It's what problem are you tackling? So I think that approach is very much needed. Now, given that you have that very clear problem and use case that you are catering for, which apps at the moment are best suited to be built on Say? So if we look at your current developer landscape, can you shed a bit of light on what it looks like?
So one of the most common misconceptions around Say is that it is purely a DeFi focused ecosystem. That is completely wrong. Say is the most general purpose type of ecosystem out there because our core focus is on trading, and trading is there in every single type of application that exists in crypto. So because Say is a fully permissionless chain and because it's really focused on trading, this enables every single type of application to be built and also succeed strategically by building on top of Say. In terms of the applications that we're seeing right now, there have been over 200 projects that have committed to building on Say, out of which a couple dozen are live on mainnet right now. These applications, they span basically everything you can think of in crypto. This includes social applications. One of these would be SenatDAO, which is building political tokens. Another vertical would be gaming. So we're seeing Fable, which is building a on-chain esports league. There's also Tatami, which is essentially a gaming publisher. Beyond that, we have NFT collections that are launching. We have NFT marketplaces. We have traditional DeFi applications. We're also starting to see rollups getting built on Say. So these rollups will be offering different execution environments, building on top of the core layer one. So a ton of different types of applications that are getting built. I think the core value proposition that developers see, like, first of all, it is this focus on user experience. And one of the biggest things that I think really resonates with people building on chain is just how fast it is, because that ends up being just completely different than other ecosystems. And that does really improve the end user experience. I think one of the other reasons is strategically it makes sense to align in an ecosystem that does have users in trading activity. So if they see that a lot of exchanges, a lot of other types of committers are launching on Say, then that ends up being one of the other reasons that strategically it makes a lot of sense for them to build here.
Got it. And how about on the user base side of things? What does that composition of that look like for you guys right now?
Yeah. So similar to most other projects that had an airdrop when the project launched, a lot of the people that are there early on tend to be crypto native. So people that are like the early adopters that you would like in Web2 companies, there's like the early adopters that are like the initial like 0.5 or 1% of people. And then afterwards you start getting more and more mainstream users. We think it's similar in Say's case. Like the initial people that are coming on to any new layer one, they're going to be people that are very crypto native. Then afterwards, the question is, how do you get people, like who's the next group of users to come? The next group would be retail users. So just normal people like me and you. And then the third group would be institutions and sophisticated kind of network participants. And the way that this typically works is a network launches, and then there are crypto native people that come and engage with the ecosystem. Then afterwards, there's developers that start building applications. And if there's a killer application that gets built, then this leads to retail users coming on. And there's honestly only been a handful of ecosystems that have successfully been able to do this. Ethereum would be one of the clear examples of this. Solana would be, I mean, back in 2021, 22, definitely would be another example of this. And after there's retail users, then it ends up being strategic for sophisticated users to start coming on, because then that's when they have the most interest to be participating on chain. And I mean, in any trading focused ecosystem, they end up being the ones that help provide liquidity and help really make sure that everything works smoothly end to end. So right now, the biggest focus from Say Foundation side is to really focus on developers, because killer applications don't just emerge by themselves. They emerge when there's a clear pipeline of developers and really good developers that are convinced to start building an ecosystem. And yeah, I mean, a lot of the kind of programs and strategic initiatives that the Say Foundation is taking right now is to help grow out the developers.
Got it. Yeah, that's the right approach. Yeah, you can't really attract users if there isn't enough apps or products and like high quality products to be used within the ecosystem. That's great. Now, there's a lot of division in the crypto space, let me say that, and around a lot of topics. And one you kind of answered there, which is a topic of discussion between whether monolithic or modular blockchains are the way to go, which one is more superior. I think another very big topic of discussion that's been around forever is whether EVM compatible chains or non-EVM compatible chains are the way to go. I would love to hear your thoughts about the importance of EVM compatibility in general.
Yeah, so I mean, I can talk about both of these points. To quickly touch on monolithic versus modular again, I think that there's different approaches that you're going to want to take based off what your objectives are. If you're a super early stage team, you want to build something scrappy, you don't necessarily care about having everything just the most polished that it can be, and you're okay with taking on additional complexity, then a modular approach is great because it really allows you to have faster experimentation. You can just focus on one portion of what you're trying to build, and the other 2 or 3 parts of it, like, you don't need to worry about that. The issue here is that it leads to more complexity, because instead of everything being integrated into one chain, now you essentially, like, let's say you're building a rollup, or let's say you're building an L3, right? Like an L3 rollup is built on top of another rollup, which is then built on top of the base data availability layer. So now, in order for the top L3 layer to be functioning well, the L2 and the L1 both need to be live. They both need to be not having any issues around finalizing transactions. And it just introduces much more complexity into the overall process. So we think fundamentally that this having a smaller thing to focus on will lead to better experimentation. But if you need to have integrated, or if you want to have the best possible performance, where everything just works as quickly as it can, and you're able to support lowest time to finality, most throughput, you're invariably going to need to have an integrated approach, because this will remove a lot of the complexity while still being able to get all the benefits of the modular approach. Like anything that's built in at the DA layer, you can build that into the L1 itself. Like something like data availability sampling, you can build that into any layer one. So 5 years from now, I think that the best, most performant infrastructure will be a monolithic or integrated chain. It's not going to be a purely modular design. The second question that you asked was around EVM compatibility and how, I guess, important that ends up being. So I think there have been many examples of chains that have done well without having EVM compatibility. I think one of the most clear examples of that is Solana. Back in the day, Terra also did not have EVM compatibility. It was still able to grow an ecosystem. I would say overall, EVM compatibility is something that helps with alignment with folks from the Ethereum ecosystem, and especially during a bear market, that's where a lot of the users and mindshare comes from. So I think that EVM interoperability is good. It also ends up being helpful for developers. There's a lot of developers that only know how to write Solidity smart contracts. They might not be as familiar with Rust smart contracts. So it kind of reduces the friction for them to get started. So yeah, I mean, overall, I think that any ecosystem that can support EVM should. And I mean, honestly, the way that I think about this is execution environments in Web3 are similar to programming languages in Web2, which is that the programming language that is used to write any kind of application Web2 just does not matter. Like you can use whatever programming language you want to. If you go to Amazon.com, like honestly, no one cares which programming language it's written in. Like that doesn't matter, and it really should not matter. The only thing that should matter is the product and how that impacts user flow. We think 5 years from now, it's going to be the exact same thing in crypto. Like there's all these different execution environments right now. We think that these execution environments are all going to get built into whatever chain you're using. So say, for example, would be supporting EVM smart contracts and Solana smart contracts and CosmWasm smart contracts and any other type of smart contract that a developer would want to be writing. And we think that's just going to be inevitable for the industry overall in the next 5-year window.
Yeah, that's a really good framework to think about the whole EVM versus non-EVM comparison. Now, to dive deeper into this EVM topic through something that is quite a hot discussion at the moment is related to MakerDAO's endgame, and Rune coming out with quite a surprising announcement that, hey, Solana's infrastructure would actually suit Maker's endgame's new chain plans better than an EVM-compatible chain. And to quote a thread he put out on Twitter directly, he said that, but for a specialized backend for Maker's specific needs, an EVM is not ideal, and solutions like Solana or something like Sei are a much better fit. And based on what I can see from Twitter, which isn't that surprising actually, the broader crypto community, where the most vocal people belong to an ETH maximalist type of community, don't seem to quite understand Rune's point and reasoning behind this decision here. So could you help everyone out a bit and elaborate why something like Sei would suit Maker better?
Of course, yeah. So fundamentally, whenever you're building an app chain, it typically is because you want to build infrastructure that is the most performant infrastructure and really specialize for whatever type of use case you're trying to build. So if you want to build a new chain from scratch and you want to have the best type of execution environment to allow for the fastest user experiences, the EVM is really not the perfect fit because there's a lot of things that are fundamentally lacking in the EVM right now. For example, it doesn't support parallelization. It's single threaded. You need to execute transactions one after the other. And if you were to just use that, you're not going to have the best, most performant infrastructure. Like you fundamentally are going to want something that is parallelized. And that is something that Sei supports. That's something that Solana supports as well, which is one of the reasons that they ended up choosing Solana. I would say the other thing is just around state management. EVM isn't necessarily super efficient with that. Newer chains are, just because we've been able to see what has been working with the EVM and what has not been working with the EVM, and we've been able to iterate on that. So I think a lot of that went into the decision-making for not using the EVM. And I think honestly, it's kind of like people from the Ethereum ecosystem tend to be very, I don't know if territorial is the right word, but they tend to be very strong maximalists around anything being EVM driven. But I think at the end of the day, the EVM is not, at least the current way that it's built, it is not the ideal solution if you're trying to build really performant infrastructure. And I think that the approaches then that MakerDAO had on the table were, well, first of all, they could choose to take the EVM and then they could fix the problems with it, right? Like they could add in parallelization, they could make state management better. Like they could solve a lot of these issues themselves, or they could take something that's already been working for several years and just use that. And in their case, like that was kind of a no-brainer, especially because Solana, it's been live for a long time. And it's also been forked before, for example, In their post, they talk about how it's been used by Pith Network as well, which is just forking the Solana code base and then running their own separate network with it. So I think that decision makes a ton of sense. And I think strategically it is the best decision for them as well. And yeah, I mean, infrastructure like Say is just going to be offering much better user experience and much better performance. So that is, I think, going to be a no-brainer for chains that are trying to have their own dedicated L1s in the future.
Yeah, that makes sense. Now, given that MakerDAO is such a prominent project in the space, and that Rune has even publicly stated that Say is an option for the new chain that they're building, I could see that them deciding to go with you could be a pretty big driver for the broader growth of your ecosystem. So, are you taking any concrete steps, or how are you engaging in that discussion?
Yeah, I mean, so Say is a fully permissionless and open source chain. So anyone can build on top of it right now. Anyone can fork the code base and use it however they want to. In terms of more specific, I guess, communications with the Maker team, there's nothing that we can comment on publicly. But yeah, I mean, we definitely think that any infrastructure that is performant will start getting used by other people. And there will be other people that don't necessarily want to build on top of it because that might not be the perfect thing that they would want. And they'd instead want to be running their own chain with it. I think that if Say continues to perform as well as it had been, that'll be inevitable. Like there will be people that decide to fork Say to offer their own specific type of dedicated infrastructure.
Sure. Now, focusing on the development of a Say blockchain itself, could you speak a bit about the different teams and the roles that are contributing to the core development of Say?
Yeah, so I'm associated with Say Labs. Say Labs is building open source software. So we're purely a development org building open source software that will be used by Say Foundation. And Say Foundation is the entity that is running Say blockchain. But even running is a kind of incorrect term because it is a completely decentralized network. So there's several nodes that are associated with several different entities spread across multiple continents, dozens of countries. So it's, I mean, honestly, a very decentralized network, but I would say Say Foundation is the one that's most involved with day-to-day running of the actual ecosystem. And Say Labs is very focused on building the core technical stack.
Got it. Thank you. Now, I want to move on to speak a bit about your economic model and financials, because we do know that within the blockchain space, there are a lot of very different technical architectures. But also, when we look at economic models, there is no standard. Every blockchain pretty much has their own way of doing it. So, what is Say's current economic model, and how are you thinking about ensuring economic sustainability?
So I guess the core question is like, how does Say accrue value? And I think the way that Say is going to accrue value, like there's already very clear writing on the wall that MEV redistribution is going to be, like Say is already planning to have MEV redistribution be the way that value accrual happens. And I think there's writing on the wall already that makes it clear that for most blockchains in general, that is what they're going to have to move towards in the future. So they're probably going to follow Say's lead over there. So I mean, kind of higher level, what I mean by this is, so first of all, MEV, maximal extractable value, like super high level for the audience. Let's say that there's a puzzle on chain. Whoever solves the puzzle is going to win $100. So let's say that me, Oscar, both of us know the answer. So both of us want to get our transaction included as close to the top of the block as possible so that we're able to win the puzzle. So, well, initially what people would do is they would just submit transactions and then validators would have either random ordering to decide, okay, Jay's transaction will be before Oscar's transaction, or it might be like some kind of first come, first serve model where validator A had my transaction in their mempool first. So then they included my transaction before Oscar, so I was able to win that $100 puzzle. But then people started colluding with validators. They were like, yo, this is a $100 opportunity. I'll give you $10 if you place my transaction before Oscar's. And validators would be like, hell yeah, I mean, if I'm going to make $10, I'll definitely do that. So an entire marketplace kind of emerged from this, where people were giving bribes to validators and validators would be prioritizing transactions from users. And we think that just the way that mempools work and the way that validators work, if we want to be using any kind of infrastructure that has this mempool that validators can then use to order transactions with, it becomes inevitable for there to be ways for validators to make money from this. There are certain types of bad MEV that we actively choose to prevent, like front running, but other types of MEV, they're honestly necessary for the ecosystem. Things like arbitrage opportunities, like you want markets, let's say that there's two different exchanges on Say where they have different price for Bitcoin. You want those to be in sync with each other. And whoever is able to help arb that, there's economic opportunity for them to help make sure that the prices are in sync. Another example would be liquidations. Like let's say there's a perpetuals protocol that needs a position to be liquidated. There's economic incentive for whoever is liquidating the position to then Like they'd liquidate the position and then afterwards they would close it out and take on the risk themselves. So there's many examples where you want this MEV to exist, these puzzles to exist. The question is then like, how do you, first of all, have this bribing structure in place? And secondly, what do you do with the money that goes into bribes? In the case of, say, the world that we imagine is one where there is going to be some kind of auction model in place where people can basically bid on how much they want to be giving to validators to be able to get their transaction included in a block, ideally as high up in the block as possible. And then instead of having 100% of this money going to validators, we think it should be redistributed to every ecosystem, like critical participant. So not just validators, but part of it would also go to users that are helping stake the network. This ends up being a mechanism to incentivize users to keep staking their tokens to help secure the proof of stake network. It could potentially also be used for other use cases. Like part of that could go to the foundation to help with foundation operations. Part of that could also go to ecosystem teams. So there could be an ecosystem treasury where certain kind of grants could be given out as well. So, I mean, we think that the sky's the limit in terms of how this could be used. But the core idea of building in primitives in the chain where people can have these auctions and then the proceeds from these auctions will be distributed to the ecosystem. I think that's how value accrual is going to be working on Say in the future. And in terms of economic sustainability, like we think that economic sustainability is when the chain is able to, first of all, offset the cost of running validators on the chain. So validators should not be operating at a loss. In many ecosystems, they currently are. So the foundation needs to step in and give grants. We don't think that's a sustainable model. We think that whatever tokens are earned through transaction fees and through MEV redistribution, those should be going to help offset the costs of running validators. And I think sustainability is also like, how do you incentivize people to help secure the network? Like you need there to be some incentive for them to secure the network. Otherwise, they'd just be doing it out of their own goodwill, which frankly, that from a game theory standpoint doesn't work out super well. So you need to make sure that there's enough money in the form of value accrual to help offset the cost of validators and to also offer some type of incentive. It doesn't need to be super high yield. It doesn't need to be like 100% yield for staking tokens, but at least some additional yield to make it worthwhile for people to be staking their tokens.
Yeah, definitely. I do tend to agree with your definition of economic sustainability there. That's a good framing. Now, in your opinion, what are the best metrics to value or measure an L1? What are like the KPIs that you focus on, say, internally to measure your performance?
Yeah, I mean, I think you can come up with a lot. Like, I think the one core thing that defines whether an ecosystem is successful is the number of killer applications that are built on that ecosystem. If there's no killer applications, then there's not really any good reason for people to come and use your ecosystem. So a lot of the daily active users you see, a lot of the TVL, other stuff, like I think that's not going to be sticky. That's not going to be recurring usage. So you might see numbers go up, but I don't think numbers will keep going up for like 5 years from that. I think the core thing that does matter is how many killer applications are there, because killer applications are what lead to sticky usage. That's what lead to recurring daily active users. That would lead to TVL that stays committed to the chain for a long time. So, I mean, that is the primary thing to focus on. And once you have killer applications, then I think a lot of the other metrics start making more sense to focus on, like daily active users, number of transactions, et cetera, because then those actually have much more meaning. But before then, it's just kind of like very transient data to be looking at. So we think just focusing purely on killer applications is the most important thing.
Got it. Now, if we think about kind of unlocking growth at the moment, what are the biggest challenges related to that front at Say, outside of maybe just the bear market making everything hard for everyone?
Bear market does make things, I mean, in some ways it makes things harder. In other ways, it's actually really good because you're able to put your head down. As a builder, you're able to put your head down and chip. And even developers that are like building ecosystem projects, I think they tend to be much more open-minded about considering the best infrastructure to build on versus just going for whatever ecosystem is going to help them make the most short-term money in like the next 3-month window. So interestingly, I would actually say the bear market has been a blessing for us. In terms of like what is preventing Say from getting to the next level, I think that from a technical side, Say as a blockchain is doing very well. Like it's been extremely stable. There have not been any liveness issues. There haven't really been any technical issues that have emerged. So we don't think it's going to be a technical problem that prevents Say from becoming like from leveling up. I think the biggest issue would just be retail users that are not necessarily onboarding to Say. And again, I mean, the way that you solve that is by getting good developers to build killer applications. In terms of the programs that the Say Foundation has set up to help with onboarding developers, I would say that there's a few different things to point out. One is the $120 million ecosystem and liquidity fund. So this is money that investors, market makers have committed to be both investing into projects building on Say and providing liquidity on chain to any types of projects that need them. And I think this will make it much, much easier. And we're seeing that already play out, like much easier for projects to get launched on Say and then start getting traction. The second thing is an entrepreneur in residence program. So if you're not sure about what type of application you want to be building, but you know you want to be building something, then Say is offering an EIR program to help good developers, good business marketing folks get started building. And there's also going to be a ton of ecosystem events, things like hackathons, hacker houses, hacker boats. We just make it easy for people to play around, start building something on Say, and then if they're able to build something cool, then there's going to be support that gets offered to them as well.
Yeah, definitely a big challenge to tackle, but it sounds like your approach is well suited for that. And then just finally to wrap this up, what's next for Say? If we look at your ecosystem at the moment, what are the most exciting things going on that viewers and listeners should be looking out for on your kind of near-term roadmap?
Yeah, so I mean, there's going to be technical improvements and there's going to be more ecosystem focused improvements. In terms of ecosystem focused things, I would say the things that have been announced so far are primarily hackathons and in-person events. So if you want to learn more about that, you can follow Say Network on Twitter. And there's many announcements you can look at to help follow along with whatever, especially in-person events are happening in an area close to you. From the technical side, the way that we're thinking about it is, okay, Say is at this point right now where we're offering 390 millisecond time to finality. We're offering 20,000 orders per second. Like, how do we make this better? And there's a ton of ideas we have for how to make things better. So we're going to be focused a lot on decreasing time to finality, improving throughput, supporting zero knowledge light clients, which will further support decentralization. And the last thing that I'll mention is around, I guess just consensus changes that would be made to support all of these things as well. So there's a lot of different projects that Say Labs is working on from an open source capacity that could definitely help improve the user experience on Say.
That's great. And going to be following closely to see how everything plays out. Thank you so much, Jay. I really appreciate you taking the time to do this and giving us a comprehensive overview of the current state of everything going on within your ecosystem and also kind of the broader blockchain landscape. So hope we can do this again sometime.
Awesome. Thank you, man.